So you just bought a house and you also own a business and you want to minimize the costs associated to all the interest payments that you make on your house. Well, there is a trick to that, and this is what we're going to cover in this video. If you own a house and you also have a business that is at your name, there is ways of making the payments that you make to the bank for your house income tax deductible. How do you do that? It's this whole trick called a home equity line of credit. Anyone has access to the home equity line of credit. That's not the trick in its own. But the way the trick works is, let's say you bought a home for $200,000 and or you bought it for more, but your actual mortgage is $200,000 on it. And you also have this company on the side that you run, and you might have your own kind of other sources of income. It doesn't really matter. You have a company on the side, but it's at your name. Well, if you're running a business and you're making $50,000 a year and you have $30,000 in expenses, well, typically you'll use some of that revenue and you'll just pay off for all your expenses. You won't really need to accumulate debt in this business because the business is actually making profits. It's not losing money, so you don't really need to borrow. But you can say that $30,000 in expenses, you actually borrowed to pay for those expenses, and you borrowed from your home equity line of credit. So every year that you do this amount of money that you've spent on expenses can be transferred in that home equity line of credit, meaning that percentage of the interest that you're paying on this house will actually be smaller and smaller. There's going to be more and more of it that's going to be income tax deductible. So let's take an example. Imagine that you have a house that your mortgage is $200,000 and the interest rate is 5%. So that means every year in interest, if you don't pay any of the capital down because you have a line of credit on that mortgage, you owe $10,000 worth of interest. And at the same time, you're running a company, and that company is generating, let's say, $40,000 in revenue and $20,000 in costs. Well, each of the years that you run that company, that $20,000 in costs can be seen as you're taking a loan to pay off those costs, and that loan is through your home equity line of credit. So after the first year, if I think about this $200,000 that you owe interest on, you can say that actually you've paid down $20,000 of that interest on your mortgage, and at the same time you've had $20,000 worth of expenses to your business, and that just leads to the same kind of situation that you still owe $200,000. But now out of this $200,000, there's $180,000 that is what you personally owe on this mortgage, whereas the $20,000 or 10% of it is actually what your business owes on this debt. What that means is out of the $10,000 worth of interest, there's $9,000 of that $10,000 that's personal, and then there's this $1,000 that is actually seen as an expense to your business. And this $1,000 in expense, it lowers your revenues, it lowers your net income for that business, and it means that you owe $1,000 is less. So let's say your marginal tax rate is 50%, you're actually saving $500. You're saving half of the interest paid on that. And that's only after year one. So you could imagine if I go through this process over and over again, I've gone from $200,000 where all of it is my own interest I have to pay to $180,000 and $20,000 is business. The year after, $160,000, $40,000, $140,000, $60,000, and so on and so forth. At some point, I'll end up in a situation where all of the interest that I owe on my mortgage is actually income tax deductible. It's seen as an expense. And essentially, if you're at roughly 50% marginal income tax rate, it means that you're paying half of those interests, because half of them you're getting it back through your income tax returns. So that 5% interest rate that you're paying on your mortgage is actually similar to only paying 2.5%. You're able to lower your expenses drastically through this process over time. So it's something worth considering. If you have a big business that's generating a lot of money, this process can actually go faster. Imagine you had $100,000 worth of expense. Within 2 years, all of your interest that you owe on your mortgage is actually income tax deductible. So if you guys own a business that is under your name, that is not a separate entity, and you also bought a house, I highly suggest you to look into this trick, because it could lead to very large savings over time. Hopefully you guys enjoyed this video, and I'll talk to you soon about different ways you can save money or make more money with what you have. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real-life examples. Have a good day.